10,000 digital dollars became worth roughly $8,700 over one weekend. The tokens were still in the wallet. The blockchain was processing transactions normally. Nobody had hacked the code. This was USDC, a stablecoin designed to perform one exceptionally boring job: remain worth $1. Then, in March 2023, it traded close to 87 cents. The problem was not buried inside some complicated smart contract. It was $3.3 billion sitting inside an ordinary American bank. Circle, the company behind USDC, held part of its reserves at Silicon Valley Bank. Then, the bank failed. Circle still had a claim to the money, but nobody knew how quickly it would regain access or whether the full deposit would return. Traders started selling. Then, U.S. authorities announced that Silicon Valley Bank's depositors would be able to access all their funds. Circle's deposit was protected. Confidence returned. USDC moved back toward $1. The blockchain worked before the panic, during the panic, and after it. The thing that restored confidence was outside the blockchain. That could have remained one strange weekend involving one failed bank, except the same basic arrangement now supports a stablecoin market worth roughly $320 billion. The tokens circulate across digital networks. The assets backing them sit somewhere else. So the interesting question is no longer just why USDC fell. What happens when a huge pool of money can move 24 hours a day, while the reserves underneath it still depend on banks and traditional financial markets? Buy 100 stablecoins, and the issuer creates 100 tokens. Your $100 does not travel inside those tokens. It goes into a reserve portfolio, usually made up of things such as bank deposits and short-term government debt. The token can move between wallets in seconds. The bank deposit underneath it follows banking rules. A treasury bill may need to be sold before it becomes cash. The stablecoin runs all weekend. The money backing it may still be waiting for the financial system to open. Normally, traders keep the price close to $1. If a token falls to 99 cents, a large trader can buy it, redeem it with the issuer for $1, and keep the difference. That buying helps restore the price. But the trade only works if the issuer can produce the dollar. During the Silicon Valley Bank failure, traders knew Circle owned reserve assets. What they did not know was whether all of those assets would be available when people asked for cash. USDC recovered. Anyone who waited saw the market price move back toward $1. Anyone who sold near the bottom may have locked in a much larger loss. And waiting is not always harmless. It is one thing if the tokens are idle savings. It is another if that money was meant for payroll, rent, or another payment due that day. An asset can eventually recover its full value and still fail as money at the exact moment somebody needs to use it. Your normal bank balance is also a promise. Your bank owes you dollars. It does not keep every customer's money untouched in a separate labeled box. But banks share a settlement system. Eligible deposits may be insured. Banks settle with central bank money. Solvent institutions can obtain temporary liquidity when demand for cash suddenly jumps. Stablecoin issuers use the same dollar symbol, but each issuer has its own reserves, banking relationships, and redemption rules underneath it. In calm markets, those differences are easy to ignore. By the end of May 2026, stablecoins had grown to roughly $320 billion. None of the real assets backing those tokens live inside a blockchain. They sit in bank accounts and short-term financial markets. So stablecoin issuers are not just technology companies running digital ledgers. They are also managing enormous reserve portfolios, while promising holders that their tokens can be converted back into cash. The larger that promise becomes, the more important the location of those reserves becomes. And this is where the direction of the risk begins to change. Silicon Valley Bank showed how stress inside a bank could spread into a stablecoin. Now, reverse it. Imagine a purely illustrative 10% redemption wave across a $320 billion market. Issuers would need to produce about $32 billion in cash. That money has to come from somewhere. They might withdraw large deposits from banks. They might wait for assets to mature. If holders want their money sooner, issuers may have to sell short-term government debt. The panic begins inside wallets and exchanges. The actual withdrawals and sales appear in the conventional markets holding the reserves. A $32 billion cash demand would not automatically cause a financial crisis. Markets may absorb it, and central banks can respond if wider funding conditions become stressed. This is an illustration, not a forecast. But the connection matters. Safe assets answer whether the money is likely to be there eventually. They do not guarantee that several issuers can raise cash at the same time without affecting banks or markets. The system supporting stablecoins can transmit stress in both directions. Stablecoins became popular because they do things the conventional system often handles badly. They can move around the clock, they can interact with software, a payment can automatically trigger another action. Money and an asset can change hands together instead of moving through several institutions that update separate databases and reconcile everything later. Cross-border payments can still involve multiple banks, limited overlap between operating hours, and several handoffs. Stablecoins proved that this process could be faster, and that achievement survives every criticism of their reserve structure. The response from central banks is not to reject tokenization and send everyone back to paper checks. The BIS argues that regulated bank money could move on programmable infrastructure too. Commercial banks could issue tokenized deposits. Banks could settle with one another using central bank reserves. Payments and tokenized assets could move together, reducing delays and repeated reconciliation. The user gets faster, more automated transfers. The backing remains connected to the system already used to keep ordinary bank deposits exchangeable at face value. Project Agora is testing part of this approach with central banks and regulated financial institutions across several jurisdictions. It is still an experiment, not a finished global payment system. But the direction is revealing. The institutions stablecoins appeared to bypass are now trying to absorb the technology themselves. Go back to the USDC panic. The token could still move from one wallet to another. The blockchain performed exactly as designed. What the market questioned was whether that token could still become a full dollar. Stablecoins made dollar claims faster to transfer, easier to program, and easier to use across digital markets. They had not made the assets behind those claims independent of banks, government debt markets, or public institutions. Moving a dollar claim and guaranteeing a dollar claim are different jobs. Stablecoins made serious progress on the first one. They still borrow much of the second from the banking system they appeared to bypass. And that may be where digital money is heading. Not stablecoins making banks disappear, but banks quietly taking the part of stablecoins that actually worked.